Hello everyone, welcome to this lesson of today. My name is CP Otieno, and today we want to look at our lesson 3. Just like we had mentioned in our previous lesson, we were to have a look at how to pass the entries in the journal. We had already discussed the financial transactions, we had discussed about the assets, liabilities, and capital, and today we want to see how we can put them into practice. So allow me, friends, to jump into the first question of the transactions, or a question that can help us know how we can be able to pass the journal entries, record the following transactions in the journal. When you come across a question of that kind, and then you are given a list of transactions that took place during a particular period, this is what we are going to do. First of all, let us read through the question so that we can be able to have a clue of what we are going to handle today. There is a lady called Bestie. This Bestie had decided to start up a business. And now we are being given the details of the transactions that took place within the month of March. And we want to use the details of those transactions to see if we can be able to pass the journal entries for the business of Bestie. On 1st March 2020, Bestie started a business with $90,000 deposited into the business bank account from her own savings. Number 2, on 3rd March 2020, purchased furniture worth $5,000 by check. On 5th March 2020, purchased goods worth $20,000 and paid by check. On 8th March 2020, sold goods worth $15,000 to Saddam on credit. On 12th March 2020, paid for advertisement expense by check amounting to $400. On 14th March 2020, purchased goods worth $26,000 from Maggie on credit. On 15th March 2020, withdrew $10,000 from bank, kept it in the office for business use. On 18th March 2020, sold goods worth $25,000 in cash. On 19th March 2020, took $7,000 in cash from the business to pay school fees for son. On 26th March 2020, Saddam returned goods worth $350. On 30th March 2020, received $12,000 by check from Saddam. On 31st March 2020, paid Maggie $24,000 by check. Now, friends, that's what we are having as our question for today. And with the long list, we would want to see how we can be able to record. Remember, we had already defined accounting, and we said it is the process of recording, summarizing, and analyzing financial transactions. So now we have here with us the financial transactions for Bestie. After having been given the financial transactions on different dates, we are expected to record them somewhere. We are going to use the journal book to help us record the financial transaction for Bestie's business. The journal book is also known as the Book of Original Entry. I would like to remind us about the practical application of double entry concept that we discussed in the second lesson. And we said that we are going to borrow much from this table. So today, a time has come that now we want to start implementing whatever is captured in this table. Let us start with the one that happened on 1st March 2020. We are supposed to be having date. We have the date there. The next thing that we need to have is the details. We need to have the details. Then here is the ledger folio. Here we have debit side. Then we have credit side. Remember, the first question was saying here, on 1st March 2020, Bestie started a business with $90,000 deposited into the business bank account from her own savings. Number one, you have to identify the accounts that are affected. Remember, when you were talking about the double entry concept, you were saying that this is the concept which dictates that for every debit entry there must be a corresponding credit entry. So the points that we need to note are, number one, the money is coming from her own savings. And the other thing is that the amount is being deposited into the business bank account. So here, two accounts that have been affected that you can see clearly. Number one, we have the bank account, and then number two, we have capital. How is capital coming in? We had already explained that capital refers to the owner's claim in the business. The owner's contribution in the business is what we call capital. So if you are being told that Bestie took money from her own savings and invested into the business, Bestie's claim in the business is $90,000. And this amount has been deposited into the bank account. So two accounts have been affected, that is bank and capital. The date was 1st March 2020. The two accounts that have been affected here are capital and cash at bank, or the bank account. We have got an increment in the two accounts. Remember what we said in the rule that we are having in this table. When assets increase, we debit. When capital increase, we credit. So we are going to debit asset and we are going to credit capital. Let us start by the one that we are debiting. So we'll just write here bank account. Then here we'll write $90,000. Instead of writing $90,000 every time, we can write here, we can specify the currency. You can just find a space. You can write the dollar somewhere to ensure that the record that you are putting down is explained in terms of the currency that the transactions were operated on. And now we need to complete the double entry concept by crediting another one, which is capital. So we shall have capital here, capital account, and we record the same amount. Someone would want to understand what has taken place here, what is happening between bank and capital. So you have to put some summary or a summarized description for the same. You can do your own, but let us just have an example here. Just say being capital introduced into the business, being capital introduced into the business. You can have your own wordings. The description that is put down here can never be standard. Everyone can do something similar to this. Then you underline to make this account look neat and to separate the first entry, the first transaction from the next. Then now we move to the next transaction. On 3rd March 2020, purchased furniture worth $5,000 by check. Just like we did in the first one, we check the accounts that have been affected. And in this case, you can be able to sense something by the word that has been mentioned here, check. So that one, every time you hear about check, these people are telling you about the bank. We have got an asset that has been purchased, which is furniture. And furniture in this case becomes a long-term asset. The other account that has been affected is the bank account because we have used check to pay for the furniture. The asset bank that we had, part of it has been used to acquire another long-term asset which is called furniture. So we have got two accounts that have been affected here. The two accounts that have been affected here are the furniture account and the bank account. And remember, they fall in two different categories of assets. Furniture falls under fixed asset or long-term asset or non-current asset, while the bank falls under current assets or short-term assets. So the two accounts that have been affected, those are the only accounts that we need to feature on the face of the journal. So we just come here and say, on 3rd March 2020, when assets are increased, it is being debited. When it reduces, we credit. So which type of asset has been increased and which type of asset has reduced? A part of the bank has been used to purchase furniture. So it means furniture is going up while the bank that has been used to acquire it is going down. So the asset that is reducing is credited, the asset that is increasing is debited. So you'll just write here furniture account. Furniture account. Furniture account. And then we have the other one called the bank account. The bank account and the furniture account. So the furniture has increased by how much? By $5,000, as you can see here. Purchased furniture worth $5,000. So that is the same amount that will come out from the bank. So we debit furniture with 5,000 and then credit bank with 5,000. The double entry concept is complete. Being purchase of furniture, and then you can underline so that you separate it from the following transaction. The next one that we are supposed to have, we are done with the first one, the second transaction. Now we go to the third transaction, this one. And we are saying, on 5th March 2020, purchased goods worth 20,000 and paid by check. I said when you see the word check, you know bank is involved. So already you've seen one account that has been affected. It is called bank account. The other account that has been affected is we have the stock increasing. We are going to use the account purchases account instead of stock account. So we'll debit. We have said that we have two accounts that have been affected, the bank account and the purchases account. Both of the accounts are assets. Stock is a current asset, bank is a current asset. So this is a transaction that affects assets within the same category. It is affecting assets under the category of current assets. So it is almost like a reclassification of the amounts. We have two accounts. We have purchases account and we have the bank account. The bank account has been used, it means it has reduced. So just go and check assets. The reduction in asset is being credited, and which account has been reduced? It is the bank. Then if we only have got two accounts that have been affected, you can be able to identify one in terms of the treatment. Then the opposite becomes true. Other people also say that if the asset that has been increased is debited, then the vice versa is true. It means that the other asset that has been decreased should be credited. So as long as you can be able to identify an account that has been affected and in which direction, and you can come up with a conclusion that we only have got two assets that have been affected or two accounts that have been affected, you've already known what to do with one account, then the opposite shall be done to the other account. In accounts, we don't have in between. We just have you either debit or credit. There is no in between. Debit the purchases account and credit the bank account. 5th March 2020, we have purchases going up, purchases account going up, and then we have the bank account. So purchases is going to be debited. Goods were purchased worth $20,000. The dollar sign is up here, so you don't need to rewrite it every time. And then the bank has reduced by 20,000, which was used to purchase the goods, being goods purchased in cash. The cash that we are talking about here is not the cash at hand. Remember, we also have cash at bank and cash at hand. And we have got two types of transactions. We can either purchase on credit or purchase in cash. So in this case, we have these goods have been purchased on cash terms. You can also come up with your own explanation or the narration. Putting the narration there is not a big problem. And I said it is not standard. Anyone can just put in anything there as long as it is relevant and it can lead somebody into knowing actually what happened. On 8th March 2020, sold goods worth $15,000 to Saddam on credit. Remember we talked about two types of transactions that are done. We have the credit purchases or the credit transactions, and we also have the cash transactions. So in this case, now we are meeting for the first time a transaction that is made on credit. What are the accounts that have been affected there? We have the sales account going up, while on the other hand, we have a debtor. A debtor is being introduced into this business through the transaction that has been made on 8th March 2020. Goods were sold on credit worth $15,000. So a debtor is an asset, a current asset. We have the asset which is increasing. We are having a debtor there, so we are going to debit it. As I had mentioned, once you've been able to identify one account to be treated by debiting or by crediting, then the other corresponding account takes the remaining option. So in this case, the asset we have said we are going to debit. Let's record here on 8th March 2020. Then we have Saddam's account. The amount that is captured there is $15,000. $15,000. We have sales being made. Sales account. So now we are going to credit this account. So here with the same amount, just say 15,000 being sales made to Saddam on credit. That one is very comprehensive. You can be able to know what is happening in that transaction. On 12th March 2020, paid for advertising by check worth $400. $400 were paid out to a company that was offering advertising services to Bestie's business. So now that means it is an expense. The advertising that was done here is an expense. Remember here we have paid for advertising by check. The check here tells us about the bank. So we have the bank and we have advertising expense. This is an expense, this is an asset. What happens when expenses go up? You debit. And then what happens when assets go down? You credit. Let us have the date, 12th March. 12th March 2020. And you say here, advertisement account, the bank account. The money was paid by check. So what was the amount? The amount is $400. So just write here 400, and 400 should be used to reduce our bank account. Being payment for advertisement expense. Now on 14th we have purchases of goods worth 26,000 from Maggie on credit. We have purchased goods, and if we are purchasing on credit, it means the person who is giving us goods is expecting us to pay, and therefore that is a present obligation. That is a liability. It is a current liability which is expected to be settled within a period not more than 12 months. This person called Maggie is our creditor. A creditor, it is the person to whom money is owed. We have purchases being increased because we are receiving more goods, however much on credit, but we are receiving goods, so an increase in the asset is debited. So we shall have here purchases account, and then we have the other one called creditors account, and in this regard we have Maggie's account. So the amount of goods was $26,000. So you also have here $26,000. On 15th March, withdrew $10,000 from bank and kept it in the office for business use. This one now is about cash at hand and cash at bank. So money is coming from bank to cash at hand. So we'll just have those two accounts. We have two accounts that have been affected. We have the bank, and we have and kept in the office for business use. So that one is cash at hand. Cash. We are saying we take this one to cash. Why? We are being told that it is the money that is kept is meant for business use. Therefore, we just say that one is cash at hand. We said when assets are increased, if you can remember, when assets are increased, we have to debit. When assets decrease, we need to credit. So the date of 15th March 2020, we have what is reducing, what is growing. Cash at hand is increasing. So we can say here cash at hand or cash account. And then we have bank account. So this one is what we call a contra transfer, a contra entry. We'll just denote it with the letter C. The letter C stands for a contra entry. It is a transaction that involves the business account. Money is just rotating within the business. It's not leaving the business. It is just being reclassified. It is being taken from bank to cash. So it has not gone out, money has not come in. $10,000. And this other side, $10,000. Being cash withdrawn for business use. On 18th March, sold goods worth $25,000 and received cash. So we can see we have sales and we have cash being received. So it is sales being done on cash terms. So cash at hand will be affected and the sales account will be affected. So cash is an asset. When an asset is increasing, we debit. The other one will be given an opposite consideration, an opposite treatment. So we have here on 18th March 2020, then we say here cash account. And then the other one is sales account. The amount is $25,000. So we have $25,000. This other end also $25,000. Being goods sold in cash. Goods sold in cash. That is just enough, but you can also have your own. You can make it as long as you want. You can make it as short as you want. On 19th March, took 7,000 cash from the business to pay school fees for son. You can see this school fees for son is not really helping the business in any way. We shall consider that as a drawings done by the owner of the business. We are going to have drawings account which will affect capital, and we are also going to have a cash account because money is being picked in form of cash. So here we'll have cash being reduced. When cash reduces, that is an asset being decreased. When an asset is being decreased or being reduced, then we are supposed to credit it. And now the other entry is the drawings. So we have drawings which will affect capital. Drawings here, drawings account. And then we write the amount that was given there as $7,000. And then we have cash, cash account, $7,000. Then you say being money drawn by the owner. Being cash drawn by the owner for personal use on 19th March 2020. This dollar symbol, you can put it down somewhere. So I want to use it here. You can use it somewhere here. You can use it somewhere here to mean that everything contained in this column will be in dollar currency. Everything contained here is in terms of dollars. So on 24th March, return goods worth $600 to Maggie. Returning it to means it is returning outwards. So we normally have returns inwards and returns outwards, which I know I will have a good time to take us through in a better way so that we can understand what normally happens between return inwards and return outwards and how they affect the sales and the purchases. When goods are returned outwards, it means that we had some goods that were purchased previously. So maybe because of one or two reasons they are being returned to the supplier. And the supplier in this case is Maggie. Remember, we were having Maggie as a creditor. So we are reducing our credit level by returning goods worth $600. We start by identifying the accounts affected. So we have Maggie's account and we have the purchases account, because we mentioned that the goods that were previously purchased from the supplier, when we have goods being returned outwards, it means we are returning goods that we had already purchased, we had previously received. So we use the account of purchases to effect that transaction. So the effect is on the purchases account and Maggie's account. So purchases account is going to reduce. When asset reduces or when goods are reduced, then now means we are supposed to credit. And now Maggie's account is going to be debited. Maggie's account being debited with the amount is 600. The purchases account that we had already increased. Now we are reducing them. The purchases account. So here we write 600. Goods returned outwards. The connection is between our business and the third party. So if the information is talking about the third party, remember it's relating to our business. So where is Saddam returning the goods to? Saddam is returning goods back to our organization. The goods that were returned were worth $350. We had some sales that were previously done to Saddam. And now Saddam, based on some reasons, Saddam has decided to return goods worth $350. So we are going to affect the sales account. So that is returns inwards. Returns inwards. So that one is affecting our goods by increasing the number of goods, or rather the quantity of goods that we have. And that one is like an increase in the asset. An increase in the asset is being debited. Sales account. And then we have Saddam's account. Saddam's account. Saddam being a debtor, when Saddam returns some goods, then it means the level of claim that the business had against Saddam reduces. So goods worth 600. So we shall debit here 600. Let the goods come so that it increases the quantity of goods that we have. So goods worth 600 is being debited. The asset good is being increased. So that's why we are debiting. And now Saddam being a debtor, when there is a reduction in an asset, in this case the debtor, we are supposed to credit. So we'll have here 600. On 30th March 2020, received $12,000 by check from Saddam. So Saddam, who is the debtor, is paying $12,000 in settlement of the debt that he had. Saddam being a debtor and reducing the debt, so that is an asset being reduced. So an asset, a reduction in the asset is being credited. So the name Saddam will be credited as a debtor, and we received this amount by check. Remember what we said about the check. It's about bank. So the bank is going to be increased by 12,000. So we write here bank account 12,000. Bank account 12,000 and Saddam's account 12,000. Being cash, or you can say here being check received in settlement of debt. On 31st March 2020, paid Maggie $24,000 by check. Remember, Maggie was a creditor. We paid Maggie by check in settlement of the present liability or the present obligation. Now we are using bank. Remember the word check here. We are using bank to settle a pending liability. So we'll be having here, bank is going to reduce and the creditor is going to be debited. So we'll have Maggie's account being debited with 24,000. And then we have bank giving out 24,000. Bank account 24,000. Being credit settlement. Being credit settlement. It is 31st March 2020 and the upper one was on 30th March 2020. So this one brings us to the end of recording financial transactions as we had seen here. So we are done with the topic of journal entries. And now you see this list of record that we are having here, this one here, going all the way until you come this other side. Yeah, this is what we call the journal. So we normally record this in a book in this particular template, and then that is what we call the journal. So if by now someone would explain to you that a journal is a book in which all financial transactions are being recorded. It is the book of original entry of all the financial transactions. Now you can be able to understand what we normally talk about. Now our next lesson will be looking at the general ledger, and we'll be looking at specifically how we can be able to put that finer detail in the ledger accounts of specific assets, specific revenue, specific liabilities, and expenses. We'll be using the same question to look at the next topic, which is ledger, how to pass entries in the ledger accounts from the journal record. So the journal record that we are going to use is this one that we have developed today. I hope we are going to meet in the next video. Thank you for taking your time. Thank you for listening to me. Thank you for everything. May God guide you. May God keep you safe until we meet in the next video. Don't go without subscribing to this channel. If you have a comment, put a comment in the comment section there. If you want to see this video come your way every time, be notified every time by clicking on the notification bell up there, so that every time I upload any video of this kind, then you'll be the first person to get this information. You will get the notification, that is. My name is CP Otieno. Thank you so much.